Per usual, everything on this channel is for educational purposes only and is not intended as financial advice. It's Teaching Tech Tuesday. I wanted to talk a little bit about portfolio rebalancing, kind of discuss the types of ammo the sales and marketing teams are going to be using to sell Bitcoin to TradFi, and how we on the risk enjoyer side of the pond can learn some lessons from those ideas or those ideals or those theories. One of the reasons Bitcoin is so special is that it's obviously outperformed the world for the most part over the past decade. The past doesn't predict the future. Everything is hypothetical here, right? But all things being equal, should this continue, it's getting harder and harder to ignore. Hence why BlackRock probably wanted an ETF in the first place. Why Bitcoin has sort of slowly changed hearts and minds over the years. Whether you're a pre or post ETF Bitcoiner with any percentage allocation, eventually you realize, oh, this thing really has a chance at running when it starts to run. It's very momentum driven, trend driven. Many of us who are here are sort of all in, right? We're 100% risk or 100% Bitcoin or 100% alts or whatever, right? Most people listening to this video are in their mid 30s, male. And when you're younger, you want the risk. As you age, right? You see those target date funds that go from 80-20 to 70-30, stocks, bonds, whatever. Over time, as you get older, right, your time to create wealth diminishes and you're in the wealth preservation camp. One of the reasons why, aside from just being uninformed, one of the reasons why it's good as you're younger to embrace the risk, right? Trade the altcoins, do whatever you want. But just keep in mind, it's not what you make, it's what you keep. And there are ways to mitigate drawdown, mitigate risk that, technicals we talk about all the time. Learning lessons from rebalancing 60-40, 80-20, right? So the first question is, what percentage? For most of us, it's 100-0, right? Most of us have 0% cash at any given time, 0% treasuries or bonds. We're just 100% all in. We're completely exposed to the volatility. We embrace the volatility. So volatility, drawdown, Sharpe ratio, which is a way to standardize the returns and the volatility against the risk-free rate, which is the 10-year yield, help understand from portfolio to portfolio, just by looking at one number, what the outcomes have been. Again, this is always backward looking. It doesn't predict the future, but it gives you some idea of what things would have been like had you invested in X versus Y, right? So you'll see numbers like this, volatility, drawdown. We want to maximize return, minimize the drawdown. The problem is, right, the problem with the crypto and Bitcoin side, TradFi is very risk averse in the drawdown and volatility sense, whereas we in the crypto side know that in order to have these 300% years or 300% whatever months, right, there will be pretty significant drawdowns on time to time, depending on what you're looking at. So sort of a baseline between the 80-20 and the 60-40, risk on, risk off, or stocks, bonds, however you want to think about that. This is all world, I'm sure, depending on what you put in the 80 and what you put in the 20, everything's going to change this. But let's just say it's between, on average, 6 and 8%. So if we can enhance that with a Bitcoin slice without hurting the volatility too much, without hurting the drawdown too much, then that is where this thing just becomes an easy sell. And people like Bitwise and Van Eck have talked about this. And this is a recent piece from Van Eck. This is the exact type of thing that people are going to be looking at. Okay, if I would have had Bitcoin in the portfolio over X period of time, usually it's 1, 3, 5 years as far as returns. This graph goes well past 5 years, but you get the point. The blue here is the baseline, 60-40, 0 Bitcoin. Now, if you look back over 10 years, it's hard for Bitcoin to lose, right? As you zoom in throughout various bull or bear market periods, that will obviously change these numbers. But if we look at the specifics a little bit deeper, annualized return clearly improves with a slice of Bitcoin. Volatility actually drops and only expands a little bit. And then the drawdown only expands minimally, right? So everyone has a risk tolerance where they would want XYZ% in their portfolio based on whatever. That's fine. The real thing is the Sharpe ratio, where we're looking at returns relative to volatility, relative to the risk-free rate. It's a no-brainer in the 1, 3, 5 year return. We can also look at the Sortino ratio, which doesn't punish you for having positive volatility, whereas the Sharpe ratio would. So these actually improve when you're looking at the Sortino ratio. But again, if people, the first step is what would this look like in backtesting, right? So it looks great. It looks really, really good historically. It looks amazing, 1, 3, 5-year returns. So the next question is great. How much do we add to the portfolio? Do we take this equally out of the risk and risk off slice, or the stocks and bonds slice? There's some arguments that you take it fully out of the equity slice. That's probably what most people would end up doing. Let's say it's an 80-20 portfolio. 5 to 10% of the 80 may be Bitcoin for some people, right? Past 10%, and you risk, really, I don't have the hard numbers, but you risk affecting the volatility in a negative way. But again, it just depends on what people would be looking for. So the next obvious question is, okay, when do we rebalance, right? We just had a year roll over. People have talked about quarterly rebalancing. Rebalancing is just saying, okay, we have a 60-40 portfolio. Do we adjust that every week? Do we adjust that every month, every quarter, every year? Or do we just leave it alone, right? So Bitwise has done the work here as of mid-2023. And again, just by looking at the Sharpe ratio, they included Sortino as well here. Instantly, you can tell, right? Annual rebalancing is great. So the first step is, what percentage are they going to add this to a portfolio? Are they going to take it equally out of both sides of the portfolio? And then is this going to be rebalanced? Almost definitely this will be rebalanced at some point, likely quarterly, but there's certainly a strong argument for annual rebalancing. It barely adds to the drawdown. It adds to the Sortino. It adds to the Sharpe. Barely adds to the volatility. Definitely adds to the return. And certainly is added to the cumulative return. And depending on how big the ETFs get, this may end up dampening volatility broadly, because if we have these constant big rebalances, all at once, okay, if we have sort of, as we've seen around taxes, rebalancing yearly, basically, just based on tax concerns or tax loss harvesting, whatever, then that may help or hurt price, provide a floor or a ceiling, but it really depends on how big this stuff gets. I mean, if anything, this data specifically says, look, leave it alone, give it till a year, right? Add it to the portfolio and don't touch it. A lot of people are going to want to most likely harvest that gain quicker than they should be, because they may be not necessarily accustomed to the amount of upside volatility that we might see. There's also this other lingering argument where, because of the ETFs, the rebalancing stuff, the inflows, right, that may just blow out of the water any historical reference point, because it's just, previously we were our own little pond. Then they took that pond and they picked it up and then they threw it in the ocean. Okay, we are now in the ocean of capital. And that may just mess with any historical data. I think to some degree, we'll see a little bit of both. We may see a complete destruction of the 4-year cycle if we see flows and rebalances continuously. But if you're someone who's selling this to a high net worth individual, right, this is great ammo to use. Custodial concerns are gone. Headline risk is less of an issue, right? Career risk, less of an issue. So what else is left, right? The numbers have always looked good. It's just TradFi hasn't had a great place to get into the market per se, right? As we approach halving, and this is sort of as we get to like the crypto native side of things, right? As we approach halving, historically, prices tended to peak around 52 weeks after halving. We've had bigger drawdowns pre-halving. And so generally what you want to be doing, as many people have been, is accumulate pre-halving and then figure out if you potentially want to sell post-halving, just relative to the dates, right? Just looking at this, just eyeballing it, between the 25th and the 50th week, if you want some automated rebalancing for yourself to take profit, everybody has this mentality where they want to bottom take the low and top take the high. But if you can capture 80% in the middle, that's essentially what the cloud does on technicals. But if you could rebalance throughout a trend with historical price action in mind, that may help you, because a lot of people can't seem to hold when things go up and do nothing but hold on the way down, right? That's just human nature if you're not used to making money or losing money. People are allergic to unrealized profits. They can't get enough of unrealized losses. That's just the way people are. One other thing to mention here is if we look at the percentages, usually pre-post halving, within that 10-week window, we get some sort of, we'll call it a black swan, right? COVID, clearly a black swan. Bitfinex getting hacked, arguably a black swan. 2012, I don't think we had a black swan per se. We had devs rage quitting. There were some news events, nothing crazy in 2012. So I wouldn't be surprised if we have something between now and 10 weeks after halving, whether that's, crazy GBTC outflows that seem to have crawled to a halt today or whatever it is, right? But just something to keep in mind. So if you're someone who has trouble holding on to stuff and panics, right, it may help you to have just some automated process to have a plan ahead of time. You take it out of your hands and you say, look, okay, based on historical weeks after halving and price action, I want to start taking profits around 30 weeks after halving, little by little, right? So each week we're trimming a little bit, regardless of what price is doing, right? We're trimming a little bit. And then by the time we get to around a year after halving, 52 weeks after halving, we're somewhere in the 50-50 range. Obviously you can adjust this for whatever you think may happen or will happen or whatever, right? But just having some baseline expectation, because inevitably there are going to be people saying to me, taking any profits at week 30 makes no sense to me, Josh. Okay, that's fine. You don't have to do that. But this may be a sanity check for you as we're going up. And at the very least, it lets you have a little bit of cash if we do get a dip, right? Something else I've looked at historically, and this is going to sound kind of bizarre, but the other question is, okay, where do we put the cash if it's not in Bitcoin or not in crypto? One thing you could put it in is gold. And this is another type of backtest, but it's an 80-20 portfolio between Bitcoin and gold based on the slope. The 200 moving average of the S&P 500, whatever the slope of that value is, determines whether we go 80% in BTC, 20% in gold, or 20% BTC, 80% gold. So you could also use this as a risk barometer, because we do tend to track the S&P, to sort of shield yourself, as a trailing stop loss. So you may set up something like, if the S&P is positive on the 200-day moving average, the slope of the 200-day moving average, or whatever you want to think about it, then we just keep as is, right? And then if something changes, as a type of trailing stop loss, gold's obviously an option. I'm not like out here saying that's what I'm going to do. It's just, this is also an option aside from treasuries and bonds. If we move to strictly TA, we set up a system that makes sense. Based on backtesting, the two indicators that have done really well, right, are the Pi cycle top. It was created with the previous all-time highs. Okay, so this stuff was created somewhere in 2018, 2019, as well as the power law corridor. And you can say to yourself, I'm always a buyer in the bottom, right? We're currently slightly outside of the bottom of the power law corridor, but there was plenty of time down there to buy. Okay, you're always a buyer in the bottom. You're definitely a buyer with a 20-200 cross, which is what this is here. And then as a trailing stop loss, you can use the 20-week moving average, right? Historically, in a bull trend, we really don't close below the 20-week moving average until it's over. This was an exception in 2013 in that we completely reset what was going on. So you would need an additional rule there to catch what's going on here. Maybe if you get a bullish cloud breakout on the daily or something like that, you'd have to backtest that as well. But again, this is just to give you some idea of like, okay, if the numbers get as big as I think they're going to get, many people are going to get very nervous. So having some plan as far as what you're going to do based on XYZ criteria, and not trying to top tick some level, right, at 300K or whatever the level is, slowly taking profit on the way up based on, time relative to halving, may be super useful. So as an individual in crypto, you probably have an enormous amount of exposure to Bitcoin or alts or whatever else. Most TradFi portfolios are probably going to have a 10% or less exposure. That historically has shown improved Sharpe ratio, minimal increase in drawdown, minimal increase in volatility, and certainly better cumulative returns. Okay, that's really what they care about. But for us, the volatility is why we're here, right? We love it. Om nom nom. We eat it for breakfast. Love volatility. For the crypto folks, the tough part is cycle-wise, tops are always difficult. There are other signs besides technicals, but this is one set up, something to formulate for yourself to just have some idea of what to do here. And maybe you just take the yearly rebalancing approach and you say, you know what, January 2025, I make a decision. And then every quarter after that, I make a decision. Or relative to halving, and then quarters after that, you make a decision, right? But like I keep saying, in various different ways, down here, there's really nothing to do, right? You just keep accumulating if you are a believer in the cycle. And yeah, you're going to have a 10, 15, 20, 25% drawdown at some point. That's just part of the game. Historically, it's happened rather frequently intra-cycle. We can look at the 2017, 2016 run. We had 10, 15% drawdown like once a quarter, okay? So you have to sign a letter to yourself. I will embrace that. This is what I'm here for. Okay. And then make a decision, ideally a year after halving. So for this system specifically, right, again, we've never historically dropped below the 20 week if it wasn't the end. We don't really get multiple chances at this. Not a lot of data, I agree. Okay, we only have had a few cycles here. So I hope this was helpful. We'll take a look at this again, maybe in 6 months from now and then a year from now to see where we're at. That's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.